Good. Good afternoon, everyone. Thank you for joining our webinar on the basics of investing. I think we're going to give it just one more minute to see who else is coming in. Looks like we've got a few more people coming into the call here. So we're just going to give it about one more minute and then we'll get started. All right, I think we are ready to get started. So first off, I want to thank everyone for jumping onto our call today at the basics of investing. We are looking to break down some of the building blocks of investing here and really go over some good foundations to help with your investing goals here. My name is Kim Barfnecht. I'm a wealth advisor with Old National Investments and LPL Financial, and I'm joined here by my colleague Stacy Hagenston, who is also a wealth advisor with Old National Investments here. So today we're going to be talking a bit about the basics of investing. Many people find it kind of challenging to get interested and engaged with investing and with the planning and strategy that comes with it. It's totally understandable. After all, there's a lot to learn when it comes to investing. So if you do have experience with investing, though, chances are some of this will be familiar to you. But hopefully it's a very nice refresher course and maybe you'll learn a little something new throughout this presentation. Mary Beth, next slide, please. So a little bit about ourselves, so about Old National Investments. We offer a personalized investment and retirement strategies. We offer a lot here. With Old National Investments, we're not the only ones that work here. There are roughly 70 wealth advisors across the Old National footprint. Stacy and myself, we are part of a team called the Investment Strategies Team, and we service the entire Old National footprint and beyond. We work with our firm called LPL Financial. It's a national leader in the retail financial market space. Um, we offer lots of different strategies, including financial planning and advice, retirement planning, portfolio reviews, and so on and so forth. So a little bit of everything when it comes to finances here. So Mary Beth, next slide, please. All right. And so agenda time. Um, we're just going to go over some brief pieces of information for different kind of categories. And at any point in time during this presentation, if you have any questions, please put those questions into the chat and we will address them at the end during a Q&A session. So if anything comes up during this presentation, just go ahead and throw it in the chat and we will then look at those questions at the end here. So next slide, please. All right, first question. Let's talk about whether you're ready to invest or not. So over time, the way that you approach investing can change. So today's presentation is intended to give you some of the basic investing concepts that you may need to know, along with some common best practices. But most of all, it's intended to get you to take action with your financial future through investing. Next slide, please. So one of the big questions that you may want to ask yourself is what exactly is your investing approach? So some of the confidence and the sense of empowerment that comes with having a formal investment strategy for your financial goals can be very powerful. When you ask yourself whether you're ready to invest, one of the big important questions that may come up is what exactly is my approach to investing? Am I a DIY kind of person where I'm going to pick and choose my own investments? Or am I a you do it kind of person where I want to, have some help with that? So no matter your approach, it's important to know that about yourself before you start moving forward with the investing process. Next slide, please. Next up, asking yourself again, whether, sorry, investing may seem like a very intimidating process, but the sooner that you start, the easier it will be to begin building a nest egg for your future. So, since investing always involves some kind of a risk, it's important to have a solid financial foundation before you begin. Here's some key things that you may want to think about before you're ready to invest. First up, do you have a steady income? You would think that's kind of a no-brainer question, but it's actually really important because if you're only working part-time or you have income from freelancing or contracting, it may be more challenging to develop a formal ongoing investment plan. Not impossible, just more challenging. So, steady income, always good to know. Uh, Secondly, if you have any money left over after meeting your expenses, your financial obligations, that's a good thing to know as well. So, budgeting is always good to have in place. Um, Questioning whether, what kind of big life events are going to happen. So are you going through, is there a marriage coming up? Are you going to have children soon? Are you recently going through a divorce? How is that going to affect your financial plan here? And lastly, once you've covered everything else, you know, building up an emergency savings net. Do you have 3 to 6 months worth of emergency savings set aside in case of the fridge breaks or you need to put siding on your house? It's good to have a backup in case something happens and you're not dipping into your investments. So, good things to consider. Next slide, please. Uh, Second point here, we've answered the question of whether you're ready to invest or not. Now let's talk the talk and we'll go over some industry jargon. Don't worry, we'll break it down so it's super easy to understand. Next slide, please. Uh, Being ready to invest just also means having a commitment to increase your knowledge by subscribing to daily financial news reports such as the Wall Street Journal or other, available options. There are so many different news sources. This is just one option or one example. You can also ask your LPL Financial Services professional to sign you up to receive the LPL Weekly Research Insights Report. It would be sent via email every week, so we would be happy to send that out to you. Next slide, please. To jumpstart some of your investing knowledge, here's a couple of the major investing benchmarks you may be familiar with, but you may want to know a little bit more about. So, first up is the Dow. The Dow Jones Industrial Average, short DJIA, you might see the ticker symbol there, is the oldest and best known of the American stock market indices. This index actually began in 1896 and currently consists of 30 blue chip stocks. These stocks are selected by the editors of the Wall Street Journal. Not so coincidentally, is owned by the parent company Dow Jones and Company. So these companies represented in this index are quite diverse, representing a lot of the major business sectors. You might recognize a lot of them. So, for instance, Johnson and Johnson's in there, Coca-Cola, McDonald's. There's lots of different, very recognizable companies within this index. The criteria for a company to get on the Dow is that the companies are leaders in their industry and they are very, very large. It takes quite a lot, a significant change for a company to be removed from this index. And thus, the Dow is considered an important and consistent benchmark in evaluating how the stock market in general is performing. Next slide, please. Okay, next one, maybe less familiar, is another marketplace known as the NASDAQ Exchange. So NASDAQ stands for National Association of Securities Dealers Automated Quotation Systems. Although, in conversation, most people just go by the phonetic pronunciation NASDAQ, much shorter. In the last quarter century, NASDAQ has emerged as one of the largest and most popular stock exchanges and was the first to offer online trading. Stocks that are traded on the NASDAQ tend to be tech companies such as Apple, Facebook, Microsoft, Google, and Amazon. But however, companies on NASDAQ don't need to be as huge as those icons. Smaller companies such as Angie's List, which is a website that offers peer to peer reviews of home repair contractors, and 1 800 Flowers are also listed on the NASDAQ exchange. While NASDAQ tends to be mostly tech companies, it also trades some banking companies, some airline companies such as Spirit Airlines, and even a few non tech businesses like Starbucks and shoe company Steve Madden. Next slide, please. And lastly, here, one other index you may have heard about from, say, like your financial professional or from, CNBC or anywhere on the news is the S&P 500, also known as the Standard and Poor's 500. This tracks the performance of 500 of the largest companies listed on the stock exchange in the United States. This index was founded in 1926, but it didn't get expanded to its current 500 listings until 1957. It actually has 503 stocks that currently comprise that index. Um, this index is used as part of a larger computation to help forecast the direction of the economy and contains a lot of the same companies that you already know, such as Apple, Microsoft, Amazon, and Tesla. Next slide. And at this point, I'm going to turn it over to my colleague Stacy, and she's going to take it from here. Stacy, go ahead.
All right, so now that Kim has talked some of the talk, what we'll look at is what we call the 4 steps to becoming an investor. Next slide, please. So whether that's learning which of your investments are appropriate for your financial goals is really part of step 1. Whether you're saving for retirement, looking to buy a new home, funding a college education, or really any other financial goal, we'll look at the key types of investments that are available to you. Next slide, please. So a stock is basically an equity or a share as an ownership in a company. And stocks are bought and sold predominantly on the stock exchanges like the NASDAQ that Kim discussed earlier, and they're a foundation to nearly every investment portfolio. Stocks and stocks mutual funds do have high return potential, but the potential for risk is also high. So for the average investor, we typically would consider stocks as part of a long-term investment goal, such as for retirement in a 401k, IRA, Roth IRA, where you have a much longer time horizon and can afford to be more aggressive and take on more risk. Stocks don't always make sense for short-term investment goals, especially when safety and stability are important to you. Next slide, please. So a bond is basically a loan. Bonds are issued by companies, municipalities, states, and governments, and are used to finance projects and operations. As an owner of a bond, you're a debt holder or creditor to that particular issuer. Bonds have specific maturity dates and pay interest at intervals, so you receive income from that bond, and when that maturity date comes due, that turns into a payment back to you in principal, unless it's in a bond mutual fund. Bonds typically are known for their potential to generate more consistent, moderate returns, which work best in a medium type of investment goal. Maybe something like funding for college, something where you want to take on some risk, but not a lot of risk. In addition, as you get closer in your retirement portfolio to retirement, say 10 years or so, we'd typically look to make bonds a larger part of your portfolio, getting ready for those retirement dates that are closing in on us and making sure we're not so heavy in stocks, but still want to get a little bit more growth potential. Next slide, please. Then there's cash equivalents, which are typically things like money market funds. They're known for their consistent, though much lower returns with much lower risk, which make them appropriate for short-term savings goals. Say if you're saving for a down payment on a house in a few years. As you get closer to retirement, though, say 5 years or so out, we may start to look at cash equivalents as well, as those will be a safe place to put funds that don't have a lot of volatility and can be there to be able to provide that income source once you're ready to start that retirement stage. Next slide. So here we'll look a little bit at how some of these asset classes have performed over a long time horizon, as history reminds us that the greater the risk you take, the greater potential reward. So looking back from 1985 to 2022, the S&P 500, which is comprised all of stocks, has had an average annual return of 8%, while bonds has had an average return of 3%. The stable asset group, those money market funds, only 0.4%, while over the same time period, inflation has averaged 2.74%. Next slide. So the next step we'll talk at is embracing diversification, and it is really one of the most fundamental aspects of investing. As they say, don't put all your eggs into one basket. So putting your money into different number of asset classes and investment options can diversify your assets and help you manage risk. Basically, if your dollars are invested in materially different types of investment classes, stocks versus bonds, and market conditions cause one of the investments not to do so well, all of your money isn't subject to that same negativity. There's a good way to kind of illustrate diversification if we look at the story of the Lifesavers candy. Next slide. So Clarence Crane was the inventor of Lifesavers, and he invented Lifesavers in 1912. At that time, he manufactured only one flavor, which was the peppermint. In 1913, he was approached by Edward Noble, and Noble suggested that maybe offering different flavors of Lifesavers would attract more customers. Mr. Crane wasn't interested in that concept, but he did agree to sell his business to Noble for $2,900 at that time. In Mr. Noble's lifetime, he went on to develop a billion-dollar business manufacturing different flavors of Lifesavers candy. By diversifying his product, he appealed to more people, protected his business from risk of one flavor losing the popularity. So we can look at that as far as diversification and investments too, as you spread out the risk to help protect potential rewards in your portfolio. Next slide, please. So the third step is looking at the economy and how the economy can affect your portfolio. So we'll go through a little economics 101, because it's really important, and these things will definitely have an impact on your portfolio. So the state of the economy, which is how our country uses money and resources to produce goods and services, really affects the stock market activity. Whether the economy is growing, shrinking, stagnant, standing still, it does influence stock performance. And we can look at that by looking at a few different economic factors. Next slide, please. So you've all probably heard of bulls versus bears. With the bull market, investor confidence is high, stock prices rise, and as will follow your portfolio, will also increase in value. Just the opposite happens in a bear market. That's when investors lose confidence. They're nervous, stock prices decrease, and stocks become undervalued. However, this undervalue can present a good opportunity that you can purchase into some good companies at reduced stock prices, or basically stocks have gone on sale, but it has to be appropriate for your situation. Next slide. The next thing we'll look at is inflation. So inflation is there when prices are rising, purchasing power is falling, and a dollar purchases less than it used to. I think a lot of people are feeling that now. And when inflation spikes too high, you can't afford to buy as much as you used to. Companies can start to sales, causing stock prices to drop, and there goes your portfolio going down as well. When there's lower inflation, that can tend to indicate a healthier economy. Consumer confidence is a little higher, and that can be good for the stock market and stock prices. Next slide. Interest rates also play a factor. So interest rates are your credit card rates, your mortgage rates, car loan rates, even the rates that the banks have at savings, CDs, that type of thing. And it's important to know that with the market, when rates rise or fall, that does have an impact on stocks and bonds. So as interest rates increase, stock prices and bond prices tend to decrease. And the Federal Reserve, which we call the Fed, is our government entity that's responsible for implementing interest rate strategies to help support the economy. In 2019, the Fed decreased interest rates on 3 separate occasions, and they did that in an attempt to offset potential recession and avoid an economic downturn. Most recently, they've raised interest rates to try to combat inflation. So it's important to note this, what the Fed's doing with rates, because it has an inverse relationship with the market. Generally, when rates go up, stock and bond prices are going to fall. When rates go down, stock and bond prices generally can go up. Next slide, please. The fourth step is just knowing that there's professional help there when you need it. So we've gone through some of the basics in this presentation to get you started with some of the terminology and some of the information to be aware of, but there's always people that are here to help. So at Old National Investments, we can give you some hands-on personal advice and guidance to help you work toward those financial goals and see if we can help you achieve them. Here's a few ways that we can help. Next slide. So we can do things like help you understand those different types of investments like we've gone through today and their place within your particular portfolio. We'll help you determine what those financial goals are: retirement, buying a home, starting your own business, or just maybe some basic finance details. We'll help you determine an appropriate investment strategy toward achieving some of those goals. We'll talk about your risk tolerance, your time horizon, and put that all together in a package. We'll discuss professionally managed investment opportunities that may be of interest to you and connect with you on a regular basis so that you can track your progress and make adjustments as are necessary to your portfolio. I'm going to kick it back over to Kim, so she'll go through a few points on talking what kind of investor you are.
Thanks, Stacy. So lots of information here. Mary Beth, next slide, please. So the big question now comes up. What kind of an investor are you? A very important question. Next slide, please. So, big part of just becoming an investor and taking that big leap in is determining your own personal tolerance for risk. Everyone's different. I'm different than you and the next person down the road. We have different risk tolerances or how risky we want to be. But it's important to be honest with yourself about what your own appetite for risk actually is. If you're interested in finding out what that risk tolerance is and where you are comfortable, please reach out to our team. We can provide you with a short quiz that will help you understand yourself better when it comes to investment risk, which is a great starting point towards building your investment portfolio. Next slide, please. So once we've determined your risk profile, we can then find the right asset allocation model that matches your riskiness and your comfort level. What I mean by that is it's an appropriate mix of stocks, bonds, and cash that you should consider based on your appetite for risk. So for a comprehensive investment assistance based on your own unique situation and your outlook, please contact us at Old National Investments, and we'd be happy to help. And I am going to throw it back over to Stacy for a little bit more on one of the options that we have. Next slide, please.
So I'm going to talk a little bit as we close out our presentation on one of our diversified investment platforms that we offer called Guided Wealth Portfolios, or GWP for short. There's a lot of digital investment solutions out there that offer online investment management, but most of them don't include a direct personal relationship with a financial advisor unless you have a substantial amount to invest. With our GWP platform, you'll have a team of advisors, us, that are dedicated to your account. You'll receive diversified allocations based upon your specific financial goals. You'll benefit from trading techniques that can help diversify your allocations and may even help reduce some tax impacts. GWP portfolios are made of a mix of low-cost exchange-traded funds, or ETFs. An ETF is a type of fund that groups together assets like stocks and bonds, and it's designed to provide portfolio returns in line with a specific index in the market, such as the S&P 500 that we talked about earlier. Next slide, please. So we use a 3-step process with GWP with your investment allocation track, It's basically, we'll talk about what your goal is, what's your time horizon, and what's your risk preference. So if your primary goal is retirement or a major purchase or general investing, your time frame for that goal and that specific risk preference are all going to come together to create your own personalized portfolio. We use the risk quiz that Kim talked about a little bit earlier to determine your time horizon and your risk preference. If you're investing for retirement or a major purchase, that time factor is going to be the key determinant in your portfolio allocation. Your risk preference will then determine an investment allocation track if you're going to be more comfortable investing more heavily in equity, more heavily in fixed income and bonds, or a good portion of the two. If you're investing for a general purpose, your risk preference is going to be determined by that risk preference. Is going to help put that portfolio together. Next slide, please. So our GWP program is based upon an actively managed advisory, or what we call a fiduciary relationship with you. So an appropriate account management fee will be assessed to your account. We'll discuss that fee with you, provide some additional education and resources as we go through the process. It's very easy to get started with GWP. In fact, you can even do start the process yourself through our online portal, and that would be on the website that we have on the screen here. Another way, you can call us and our team at the 877 number listed, and we'll discuss the investment options, minimums outside of not only the GWP platform. We have a lot of different investment platforms we can look at. So if this doesn't quite feel for you, I'm sure we've got something that will. If you'd like to learn a little bit more about GWP or any other of the investment strategies, we'd be happy to discuss that with you. So give our team a call and we'll go over the specifics with your particular situation in more detail. Next slide, please. So if GWP sounds like something you want to learn a little bit more about, here's just some disclosures we put on the screen that are good to be aware of, such as some of the tax strategies that are implemented don't necessarily say there's going to be any particular tax consequence, and we don't use that as tax advice. Most certainly, we always recommend you talk to your own tax professional about your particular situation. All investing involves risk and loss of principal. No strategy assures that there's going to be success or can protect against loss. There's no guarantee that a portfolio is going to outperform another, and diversification doesn't protect against market risk. Market risk is what's there anytime you're in the market. Rebalancing a portfolio is also some strategies we'll use, and it doesn't always assure that a profit's going to be gained, and it doesn't assure against losses. Next slide, please. Another important point here is just to be aware that LPL is the broker-dealer that we do use for our investment strategies, and we don't represent to provide any legal or tax advice. So we always recommend you talk to your specific professionals that are licensed to provide those services. I think at this time we may take a look and see if there's any Q&As out there that we can answer.
Sure. I had one come in a little earlier, and I might throw this to you, Stacy. Someone asked, what is the difference between an IRA and a 401k?
So a 401k is generally that investment retirement platform that you would use through a company. So when you're working for an employer, at some point in time, they're going to generally, if you're working for so many hours, there's criteria that has to be met. Your employer is going to offer you entry into the retirement plan they have set up for you. And it's a very good idea. We always encourage customers to take advantage of 401ks because your company is helping you with your retirement. So you will be, of course, encouraged to add money into your retirement, which you always should do. And the earlier you start, the more time you've got, you're going to definitely be rewarded at those retirement years, the earlier you do start. But your company matches a portion of your funds that you're adding to your 401k. So that's free money from your employer and added benefits. So always look to be a participant in the company's 401k. Versus an IRA is something you do more individually on your own. So you can set aside a certain amount of money each year, and the IRS will allow you to deduct that money that you're setting aside in a traditional IRA to take off of your taxes and reduce your income. Similarly, when you contribute to your 401k, your employer takes those contributions out of your paycheck ahead of taxes, which reduces your taxable income to help reduce your tax bill. So you can do something similar in IRAs, though you can't contribute as much in a traditional IRA. There's also Roth IRAs that are tax-free way to save for retirement. And I always encourage young people to get started in Roths early because that can really grow for you, and to have tax-free funds later in retirement is definitely going to be a benefit. Anything you want to add to that, Kim?
No, you pretty much summed it up. I am going to just say, any questions that do come up, if you think of any, please use the chat feature. There is a little chat button. You can definitely type your question into the chat and we will answer it as they come in. So excellent answer, Stacy. We did have another one come through. What is a mutual fund? And we mentioned ETFs a little bit here. Alternatively, what would be an ETF? So I can take that one if you'd like.
Sure, go ahead.
So mutual funds, essentially you have your basic building blocks, your stocks, your bonds, and your cash equivalents. And a mutual fund, I like to think of it as a piece of pie, as a big pie. You have all your different ingredients, like your stocks and your bonds and your cash equivalents, that all go into this big pie and have the specific recipe that creates your piece of your pie. And you say, oh, I'd like that slice of pie. So you get to participate, or you purchase a piece of that pie, which has a little bit of, say, some stocks, some bonds, some cash equivalents, some money market accounts, and you own a little bit of everything, and you get to participate in how that your percentage of that pie is. So you do get to, any of the dividends that get paid through, you get to participate in that as well, but you don't necessarily own a full share of anything. So I'll give an example of, say, Amazon. I don't know what the price is right now, but it's pretty costly to own Amazon right now, just one single share. You don't own one single share of anything. You own fractions of shares of a little bit of everything. So it's one way to kind of diversify things out by, owning that mutual fund that has a little bit of everything in it, depending on, how risky it is. It might be a little more stock heavy, it might be a little more bond heavy. And somebody manages that. That would be the fund manager. And just like a piece of pie costs money, you'd pay to purchase that slice of the mutual fund. So, alternatively, ETFs work similarly, except instead of mutual funds trade once a day at the end of the day, ETFs trade throughout the day. They work kind of like a stock where it changes the price throughout the entire day, but it still is that, uh, piece, that pie of a little bit of everything. So did I miss anything, Stacy?
Nope, I kind of, along with your pie feature, I tend to talk about it like a basket. You got a basket of
Oh, okay.
ingredients, so we've got all kinds of different stocks and or bonds in there. So, yep, it's just a basket of securities versus owning, say, just one company. Gives you more ease to sleep at night.
Yeah, yeah, I know. I like to go food because I'm a little bit of a foodie myself, so I like to go food references. Last question that I see here, someone asked, which is better, a Roth IRA or a traditional IRA?
Well, it really depends on your preference. So we talk a little bit about that. It's going to depend on what you currently have. I think we do an evaluation of your current financial situation, talk about what you currently have for retirement, what your income level is. So there's benefits definitely to both. If you're in a higher income bracket, a traditional IRA may be a way to help bring you down your tax bill a little bit year to year. If you've got other tax deferred retirement savings out there and you have nothing started for a Roth, I definitely encourage everyone to look at starting a Roth because taxes are only going to go up in the future. So having tax-free money later in life is definitely something to take advantage of. So it really depends on your particular situation, which is what we would talk about with you to help determine, what's going to be best for you in particular.
Yeah, no, I 100% agree. Everyone's different, so your situation is completely different, and what's good for one person might not work for the other person. So, Mary Beth, next slide, please. I don't see any other questions, but if you do have any other questions, we do encourage you to reach out to myself or Stacy or anyone on the investment strategies team. Our email is just ist@onbinvestments.com. Our phone number is listed as well. Feel free to reach out to us and just whatever questions come up, or if you are ready to take a look at your own personal situation and get a little extra advice from us, we'd be happy to help with anything that we can. So Stacy, any other last minute notes you'd like to add?
Yep, I just note there's no cost to connect with us. So certainly, if you're comfortable giving us a jingle or an email, we'd be happy to chat and see how we can help you and go from there.
That sounds great. Well, we'll give you back a little bit of your time today. Thank you so much for joining our webinar. Again, reach out if you have any questions, but thank you again and have a wonderful rest of your day.
Thanks, folks.
Thanks.